The U.S. economic picture looks bleak. The government has released a series of reports that paint a very bleak picture of the nation's economy. Jobless claims remain at recessionary levels. Americans cut back on their spending by the largest amount since the 2001 terrorist attacks. Orders to U.S. factories are falling, and new home sales fell to the lowest level in approximately 18 years. The Labor Department reported that initial requests for unemployment benefits fell to a seasonally adjusted 529,000 from the previous week's upwardly revised figure of 543,000. But jobless claims remain at recessionary levels. The 4-week average, which smooths out fluctuations, rose to 518,000, its highest level since January 1983, when the U.S. economy was emerging from a steep recession. One minor bright spot showed the number of people continuing to claim unemployment insurance dropped unexpectedly to 3.96 million from the previous week's 4.02 million, which was the highest level in 25 years. The U.S. labor market has grown by about half since 1983. Meanwhile, the Commerce Department reported that consumer spending plunged by 1% in October, even worse than the 0.9% decline that had been expected. And consumer spending accounts for 2/3 of total economic activity. Orders to U.S. factories for big-ticket manufactured goods also plunged last month by the largest amount in 2 years. Orders for durable goods dropped by 6.2%, more than double the decline economists expected. That's a bad sign. And the Commerce Department report showed widespread declines throughout manufacturing, led by decreases in autos and airplanes. That tells something of the future. The department also reported that new home sales decreased 5.3% last month to a seasonally adjusted annual sales pace of 433,000 homes, the lowest level since January 1991. Another period when the country was undergoing a steep housing downturn. But now, there's quite a few more people live in this country than back then, isn't there? The median price of a new home sold in October fell to $218,000, down 7% from a year ago, and the lowest since September 2004. The Dow Jones Industrial Average rose on Wednesday, despite all the dreary economic news or data. It doesn't really make any sense, of course. Well, in the last 3 days, the Dow Jones has risen, so we can know what's probably going to happen Friday or Monday. In the coming days, it'll probably have to fall again. But it could fall even further, because the real economic news is not good. So how does the Dow Jones Industrials still rise? It's based on false reality, or false realities and myths. Yes, maybe Obama can help the economy someday, in a couple more months or something like that. Anyway, there's a lot more to this picture on top of all this, and it is much bigger than all this. This is connected or interconnected with something much, much bigger. Real change is coming, more than anybody can actually even imagine. And it will come, with the economy showing further signs that it is headed into a steep dive. The administration and the Federal Reserve rolled out 2 new programs Tuesday that would provide up to $800 billion in an effort to get more loans flowing Theoretically, in such critical areas as mortgage lending, credit cards, auto loans, and small business loans, of course, people have to have jobs. They have to have money. They have to be making money to do this, of course. Another non-reality. Another pipe dream. Anyway, credit markets liked new efforts, but private economists said the new moves were not likely to be the last changes in the government's increasingly vast rescue program, which had already undergone significant alterations since it was passed by Congress on October 3, 2008. Economists believe more work will need to be done because of their expectations that the economy's vital signs will continue to worsen as the country slips into what many believe could be the worst recession since the early 1980s. Or actually yes, since the 1930s. The unemployment rate has hit a 14-year high of 6.5% and still rising, putting pressure on personal incomes. The government reported Tuesday that the overall economy, as measured by the gross domestic product, shrank at an annual rate of 0.5% in the July-September quarter, reflecting the fact that consumer spending fell at the fastest pace in 28 years and is still falling. One economist at IHS Global Insight said he was expecting GDP, gross domestic product, to shrink at a 4% rate in the current quarter, reflecting the continuing battering consumers are taking from the worst financial crisis, since the 1930s. And the economist predicted that the economy would remain in recession. It's going to remain in recession. And on top of that, there's more to this than anybody can actually even imagine yet. We are in the early stages of one of the worst recessions in the post-war period, even factoring in a theoretical massive stimulus program sometime next year, after Obama takes office. To revive the economy, President-elect Barack Obama has said a top priority will be working with Congress to enact a stimulus package with the goal of creating millions more new jobs over the next few years. And economists believe such an effort will require spending between $500 billion to $700 billion at the minimum, a figure that would be, on top of all the money being spent to stabilize the financial system so far or yet. In other words, how many trillions is it going to take? Do they really have any actual money to put into all these programs? Or is it just adding to the U.S. national debt? Ever increasing, faster and faster. Who's going to pay the national debt? I guess there's really no plans for that, is there? It's like maxing out all the credit cards and then just cutting them up or just throwing them in the trash and walking away, isn't it? Something on the order, if not worse. In the latest efforts to stabilize the financial system, the Federal Reserve announced Tuesday that it will buy another $200 billion in securities, backed by different types of debt, including credit card loans, auto loans, student loans, and loans to small businesses. The Fed also announced that it will spend another $500 billion to buy mortgage-backed securities guaranteed by mortgage giants Fannie Mae and Freddie Mac, and then another $100 billion to directly purchase mortgages held by Fannie, Freddie, and the Federal Home Loan Banks. The latest federal moves raised U.S. commitments to contain the financial crisis to nearly, or approximately, $7 trillion. Again, $7 trillion. Though, so far, no one thinks the government will actually spend anything like that figure. It seems like we've heard this story before. They always say they're not going to spend that much, but they always do. Where are they going to get another $7 trillion from? Just add it to the national debt, right? That's not going to work. No, it's going to bankrupt this country. And these are all more signs of the end times, transition days, and there are many, many signs.